Howdy ho, everyone, and welcome to Weekly Sunday Market Update. It's wonderful to have you on board as usual. Wow, what an end to last week we did see with the CPI figures or inflation numbers coming in. Cheers, Lexi, coming in and moving the market. Wow, did it move? And of course, the big question is going to be what happens from here. Just a quick recap before we go to our presenters this evening. And first up, we're going to have a quick look at the dollar index and see what a difference last Thursday made. Big move down, broke through support, broke through horizontal levels, and wow, looks to be a potential reversal on the way there for the dollar. Of course, that means in the opposite direction, the S&P 500 also broke through resistance, also broke through a horizontal resistance level, and again looks to be on its way. Of course, the tech stocks on the NASDAQ, not so, I guess, influential. Can I use that word? Through that resistance level, yes, but does appear to be at a second resistance level. So not as convincing as the other two, I wouldn't have thought. But of course, the big news for a lot of people will be that gold has broken through. And now is the time, or is it now the time? I don't know. I really don't know. That'll be the big question that'll be asked of a few people in this session this evening, I can assure you. And of course, the first one we will go to will be one who studies such things. And I wonder what Gordon really thinks of the big turnaround at the end of last week. Let's find out.
Hello everyone, Gordon Scott here with a U.S. market update. Before I get started, I just want to say I'm really looking forward to meeting everyone, as many of you as possible, in Bali in a couple of weeks, meeting face to face. It's going to be great. This is a pretty momentous occasion, at least in terms of technical indicators, for the U.S. dollar. It started in the past week, Thursday, when the CPI, Consumer Price Index, came out with a reading that led traders and investors to believe that inflation might be pulling back, might be, retreating from its strong march forward. There's some quibbles with that, but let's look at the charts and see what drove that and what the outcome of that report was. I'm looking here at Forex Factory and the CPI year-over-year chart as reported on a monthly basis. And you'll see that the inflation numbers really got going here in 2021, and in 2022 the Fed decided to do something about it. It took a little while for any of their interest rate hikes to have an effect, but over the past 5 months the inflation rate has come down. Now, the quibble is that's still 7.7% annual. That's still crazy high compared to where we've been in the past. So why do people think that inflation is over and that the Fed won't continue to hike rates? Well, it gets down to the nuts and bolts of how much work the Fed has to do. I think if you look at this number here, you can see why people got excited. The forecast, this is the month over month change, right? The forecast was 0.6% increase in the consumer price index, the cost of goods that the typical person has to pay for in the United States. And that number was forecast to be 0.6. Well, multiply that by 12, you see, and you come up with a number like 7.2. 7.2 is lower than what the current annual rate is, but that would be a projection going forward. So 7.7 to 7.2 as a projection would mean, we're slowly declining. But what came through was 0.04 on the month over month. 0.04, multiply that by 12, and what you get is something just under 5%. So it isn't so much where we're sitting right now, it's where people think we're going to be 6 months to 12 months from now. We could see inflation as low as 5% or less in the United States. And I think that's kind of a tipping point. People feel like, under 5%? Inflation is over. We can live with under 5%. Well, even that is still pretty high for what people are used to in the United States. But historically, if you factor in all of the years of inflation over any given 30-year period, it seems like the average is about 5.5%. Now, that means you get a lot of years that are low, and you get some years that are crazy high. Hard to tell if that's really a sustainable measure. But the fact that the trend is forecasting to go under 5%, that's what's got investors excited. And their response to this was to buy up the markets. So let me just jump here. Okay, this chart has the U.S. dollar index and the S&P 500, and also the Russell 2000 and oil. So we can see just kind of how everything was reacting to the news over the past couple of days. Small cap stocks and large cap stocks, particularly large cap stocks, really took off. Big old gap signals. Those of you who've heard me talk before about the importance of gap signals, this was a massive gap day all across the U.S. markets. But for currency traders, what does that mean? Well, it's right over there. Check out what the dollar has done. These probability cones are based on the statistical move of the past 500 days to give me an idea of how unusual the current move is. What you can see here is that recently the US dollar ran up to a point that was 2 standard deviations higher than normal, and since then has worked its way all the way down to almost 2 standard deviations below normal. That is a very significant move. And a lot of people are looking at that and saying, that's it. That's the flip. That's the change of trend. Dollar was going up. Dollar will now be going down. It might be a little early to say that, but that is, I would agree, very strong evidence. You've got lower highs and lower lows on the dollar. And for currency traders, that's all dollar-denominated pairs. They're going to be impacted by that. So you look here, we've got the euro. And of course, the dollar is going down, euro is going up. Euro is breaking out, making a lot of new high. The U.S. dollar in front of the Japanese yen, U.S. dollar going down, meaning dollar yen is going to go down similarly. And look, it's way outside the probability cones. The pairs that don't have anything to do with the U.S. dollar are going to look a lot tamer. Australian dollar, Japanese yen cross, look at that. We're just right at average. So what's really pushing the markets around out there, I mean, the things that are making the big moves are the news items on the U.S. dollar and how people are going to treat the U.S. dollar. The Australian dollar, like the euro, strongly up compared to the U.S. dollar. And this looks like it could be a very sustainable trend. So for the year 2022, I should say, we have had great currency moves if you're going long the dollar and shorting everything else against it. It is time to consider looking for trades on the other side starting this coming week. And as far as stocks are concerned, one more thing before I get there, I'll say that, I have this chart up here that I got to show you too. I mentioned a few months ago, bonds and the euro are pretty well correlated. And this is bond futures. And here we come down, and now they're coming up. But notice that the euro is leading. In other words, it bottomed out and started trending higher well before U.S. bonds did. So could be that the euro is giving us early signals for when to trade in and out of bonds. The stocks, the U.S. stock market, along with the bond market, is looking very attractive right now. Among all stocks there, probably NVIDIA, among the tech stocks, looks the best. I mean, it's just been charging up. Micron looks strong. Netflix looks really great. They had good news, jumped up. The gap has held support, and the old earnings gap held support, and now we've got a resurgence of the move. And then check out Microsoft. This is textbook. Red day down, green day up. you buy the next day and you're off to a good start already. Apple, similar performance. So for those of you who are going to be in Bali, we'll be talking a lot more about that gap signal and the best ways to use it. Until then, everyone, take care and trade well.
Yeah, cheers, Gordon. Thanks very much for that. Had a funny feeling he was going to say pretty much a lot of what he did say. And that, of course, is the big question. Are we reversing, or is this simply a big correction? I can't answer that question yet, but give us a week or so and I reckon I might have a fair idea. We shall see. I wonder what the fundamentals are doing for us. And to round all of that up, let's say a very, very good evening to Lexi. Hi, Lexi.
Hi, Geoff.
How are you, mate?
Doing great. All right. Yep. Really,
What's going on?
it was a really interesting Thursday. So I'm going to share something a bit more to do with the bonds, because when we have inflation and interest rate moves, they are pretty much almost always kind of related to the way the bond market moves as well. So let's just pop on to it. And I think the past couple of weeks, we have been talking about what we call the interest rate, the bond yield curve. All right. So we're going to look a little bit at the bond yield curve. So this is on Market Watch. We're looking at the 10-year Treasury note. You can see that let me try to zoom in a little bit. I'm just using a 1-year chart to kind of show you guys there's this drop in the bond, a sudden drop in the yields over here. I guess one way we can kind of look at it, right? I'm going to show you guys the dollar yen. So the dollar yen, we have been long the dollar yen for quite some time. But the really interesting thing is, the dollar yen and the yield curve for the 10-year yields are pretty, I wouldn't say very correlated, but almost quite. You can see that the orange line is the US 10-year yields. So it's not the bond prices, it's the yields. You can see that usually when the 10-year yields start dropping, you can see that there's a very aggressive selling off on the dollar as well. So across the board, most of the currency pairs, all right, we have that dip in the yield, and then that fall in the US dollar. So it's I'm just overlaying the 10-year yield curve against the dollar pairs. All right, and of course, if you look at the euro dollar, it will be the opposite direction. All right. The yield goes down, and it leads the general weakness of the dollar as well. So I think one thing interesting about looking at the yield curves is that according to, I think what I'm going to layer on what Gordon said about the inflation rates. So if we look at the inflation rates, right, let's just see what exactly were the changes. All right. So if we look at inflation over here, basically what happened is the inflation actually dropped by minus 0.5%. So the latest inflation, I think this is the old figure, it's actually 7.7. I think let me use Trading Economics that I didn't format it properly. So according to Trading Economics, we have the inflation down at 7.7. All right. But one thing I would like to also note is the jobless rate. So actually the previous reading, I think about 2 weeks back, we had the jobless rate coming up at 0.2 above. All right. So actually this was kind of a precursor to what possibly might be the general sentiment of the market in that sense. All right. Because there are expectations of a recession coming, expectations because people are looking at the inverted yield curve, and we are still having kind of high inflation. Plus, you can see the past couple of readings, employment is trying to pop towards the upside. So what we're looking at is a little bit of a indicators of slowdown of the economy. So the GDP figures, the unemployment figures, as well as the inflation figures, they're all a little bit, I would say, lagging. So what we're trying to, what I guess the traders and investors are doing is they're trying to forecast what's coming up. If we look at, in the future markets, and whether or not, there is anything to worry about. So over here from the Treasury website, all right, you can see just the last couple of yield readings. So we have the 5-year yield, 7-year yield, 10-year, 20-year, and 30-year yield over here. So what is really interesting to note at these readings is that across the board, on the 10th of November, the 5-year yields have dropped significantly by at least, 0.2 points at least. And we have the same going on for the 7-year, the 10-year, the 20-year, the 30-year yields. Everything dropped by at least 0.2 to 0.3 points comparatively, which means something has changed over here. All right. So we had a period of very high interest rates, the 4% interest rates. We had a period of high yields where people are buying long-term bonds because, the money is just, in terms of yields, is just more attractive. So the sudden, I would say, the sudden change in inflation kind of triggered the desire for, the desire in the bond market to kind of be a little bit wary in that sense. So what I sense might be happening is because they are expecting a cool down of the market, which means which kind of correlates with what Gordon kind of said. If you kind of project I was just going to use this reference as well. If you kind of project the CPI, right? If you kind of over here, so if you kind of project the CPI times 12 to the next 12 months, you actually have inflation about maybe 4.8%. All right, but low inflation just indicates that prices are coming down. But what is the back end of this? It also means that there's something is happening to the supply and demand of goods and services, right? So one very easy way to kind of understand it is if prices are coming down, it will kind of indicate that the market is oversupplied at some sectors, or people are kind of maybe having difficulty losing their jobs, difficulty purchasing. So we're talking more about the credit and debt market, the productivity cycle, all right, and that is usually a little bit lagging. So all this whole period where interest rates were high, between 2 to 4% in the last couple of months, I think we are going to see the impact where during those months where not as much money is being borrowed, not as much credit is being used up, we are going to see that productivity cycle kind of switch towards a slowdown. So inflation figures, they are kind of, I think, about 0.2%, it's kind of, it means it's slowing down faster than expected. So another point to note is we could expect that at some point in the next 1 to 2 years, if the slowdown is impacting jobs, is impacting, true, you get inflation down, but if it starts to impact the productivity cycle, the employment cycle, we will be seeing the US maybe consider lowering interest rates, especially if the next reading, I would say if the next CPI reading next month again falls below their projection, then it's something I would say is going to be really a little bit more scary on the job market for the US side, which means they are going to be facing kind of a slowdown. Because if we look at the GDP figures, and again, GDP figures are lagging, is a lagging indicator. Currently, it's still at 2.6. Again, it's a very slow, very lagging indicator. But I'm again wondering, is this a temporary pop-up? Previously, we've got a negative 2 quarters of a GDP cycle. So the next 2 quarters of GDP also would be pretty important to see whether that negative GDP is coupled together with increasing unemployment, because that would be, I would guess, more of a confirmation that the US market would be sliding into recession. So how will we be trading it next month? I think for the next week, I will be a little bit cautious on the long USD. Sentiment is still a question mark. Is this a temporary pullback? I'm not too sure on that because the moves are a little bit violent. I do believe there will be some retracement to the upside. All right, is this a change in trend? I guess on a technical point of view, I'll wait for that first lower high before I get confirmation. And also one eye out on the Fed speeches that's coming up next week. So next week, we have a couple of speeches coming up. What we kind of need to figure out is what the FOMC, the monetary policy over here, right? I think Thursday 9 p.m. there's the FOMC speech. So I think one way to kind of look at it is to keep an eye on the speeches to kind of get a sense of whether or not they are worried by the economy cooling off too fast, or are they still, or do they still plan to stick to their plan of continuing to increase interest rates at least 1 or 2 more times? All right. So at this point, 4% seems to be kind of working. Let's give it a couple of months to see whether inflation continues to pull back. If inflation goes down slower than expected, then I guess we could expect 1 more interest rate increase. But it looks like it's kind of undershooting in that sense, right? Which means there is going to be a high potential that the next interest rate forecast, they might not increase interest rates at all. all right, and you're just going to leave it as it is if inflation still crawls towards the downside. So I'm going to be very cautious going on long dollar at this point until a little bit of clarity comes out in the market. So I guess from a fundamental perspective, a change in trend looks possible, but I would like to wait for confirmation to jump in on that. Yeah, so will be really interesting to watch the US market and the news and to see what comes up next week. That's all for me, Geoff. A little bit of caution for me next week.
You're a chicken just like the rest of us, right?
Yes,
You're not prepared to call it, and nor am I. There's definitely not. I mean, you can't on two candles. You can't just say, okay, this entire trend, which has lasted so long, is about to end. It's do we want to see it end? Well, if you're a self-retiree.
Yeah, precisely. I mean, it's just one CPI figure, candles.
Yeah, exactly. Can it waterfall from here? Of course it can. And has the reversal started? Maybe it has, but we don't know yet. And I think you did right. You got to wait for that lower high before you even get too excited. Maybe there's some buying opportunities. We'll see. But it's really on a seesaw right now, I believe.
Yeah, I guess I will be watching the bond market quite closely as well. So to kind of see how the yields and the prices play out, because that will give us a kind of leading indicator into where the US dollar is going as well.
Yep, and I think it's going to be a very interesting week ahead. And if there is confirmation of that reversal, then look out. We become buyers on the stock markets, and we become sellers of the dollar. We'll see.
Yeah.
Thanks, mate. Much appreciated.
All right, cheers.
I think we'll probably stick with that theme, and with the potential reversal on the US dollar. I really wonder what the other indexes, currency-wise, are looking like. Lloyd's going to tell us. How are they looking, Lloyd?
Hi, good afternoon, everybody. Fortunately, I can't make it live today, so this is my recording. All right, so previously I've shared that I'm going to long Kiwi Cat, and no matter whether you trade over here or here, this will be in a pretty good profit at the moment. And unfortunately, Euro Pound previously I was trying to short it. You can see here it is. It bounced off the highlighted horizontal levels, and there wasn't any setup. Yeah, so officially now it's in a range. Interesting. Now let's move forward to this week. Is that there's nothing much change to my analysis from I think 2 weeks back, or is it a week back? Yeah, the only major change is actually to the dollar index, which I did advise not to get into it, which is a good thing. So now, top of my list for the following week, I'm still really bullish on the Kiwi. As you can see, we have already one position in Kiwi Cat. And I think it's possible to actually build up more positions on the Kiwi. Still have some space before I hit this level. Now, on saying that, this is really a short-term level. And on top of that, if the coming week ahead, price actually retests $60, this will possibly be the first retracement, and it's actually a very good position for us to get into. So keep a lookout for any Kiwi pairs. Yeah, retracement is expected up to 60, and then bounce off. This would be really the perfect scenario that happens. Next up my list is actually the British index. You can see that price has really break above this key level. Very nice horizontal level. Again, for this case, I might not really be expecting much of a retracement. Price might just really take off. Yeah, so keep a lookout for any position that we might actually build out on the pound. Next on my list is actually the Canadian index. You can see that price, very nice, moving upwards. And I suspect that the next level that it might have any interaction with will be over here, which is at the $76. You can see that previously this is where price bounced off and sort of in a range before it actually breaks down. So really healthy space for it to move up. Now Swiss, I'm really not that confident on Swiss. You can see that again, this is the between the 110 and 100. This is the level where my price usually might make a U-turn or it might break. Nothing much I can say there, except that I'm not confident in trading this at the moment. Yeah. Right. Now the Japanese yen has made a very nice, not bounce but recovery. Yeah. So how strong this momentum is, for the coming weeks ahead, I don't know, but unless it actually has sort of a retracement back to 70, I might be staying out until there's any further clarifications where you might want to go. Yeah, this may just actually be a retracement among a downtrend. Yeah, so I don't want to get into it so fast. We'll see how. Yeah, in fact, at this level, if at the H4 side, if I see some consolidation and breakout again, that might be the key that I need to trade yen long. But other than that, until it proves itself where it wants to go, I'd rather be staying out. Now the Aussie, now this is pretty clear to me that once price comes to this level, all I'm looking out for on the H4 side is just any sort of a bearish price sections for the Aussie pairs, and then I'll be quite keen to actually give it a shot. Now, overall, this is still very much in a downtrend. Yeah, so I'm not about to call a reversal on this. So let's see how it behaves. Now the Euro index, again, you can see that price pretty much shoot up to a very, very nice horizontal level, which previously actually gaps down. Yeah, sort of breaking above this level. I'm just waiting for any bearish price action before I can actually short it. And the last on my list is the dollar index, which is really, really bearish. And from what I can see, it has ample space to clear. Yeah. So as of this week, I might be getting the patient trying to short the dollar. Yeah. So let's see how it goes. As such, the top two currency which I'm keeping a lookout for is first is the Kiwi dollar. I'm just waiting for price to make some sort of retracement before I get it in, or just to break a level. Yeah, this level is actually derived from the daily time frame. And next is Euro Pound. Again, I'll be trying my best to get into a Euro Pound short position. Yeah, I'm bullish on Pound, so I'm pretty bearish on Euro. Yeah, so this is a position I'm trying to build. Now, prices officially, to me, the H4 chart price is actually in a range. So if I can actually get in a position at the top of the range, I think this would be the best for me. Otherwise, a break and retest, and we shall see how it goes. Yeah, but I'm really interested to trade at the top of the range. Yeah, before price takes off. Yeah, so this is the top two currency which I'm going to keep a lookout for the rest of the week, and this is my analysis. Hope it's not useful to you. See you.
Thank you, Lloyd. Fantastic as always. And I think the takeaway from the traders that you've listened to this evening is that maybe not. We're really not sure yet whether this is a reversal, whether it's the retracement or the pullback that we had to have. We shall see as price develops throughout the week. Perhaps it is a good idea to concentrate on those things that don't involve the US dollar. Maybe the miners might be a good plan for early in the week, and then later on, if we do see those lower highs on the dollar and perhaps the higher lows on something like the euro, like the Kiwi, like the CAD, like the Aussie, then those reversals may be able to play. Then I don't think there's any rush to get in, guys. If it does reverse, then we'll have plenty of time to jump on board. Don't think you've only got to get in right now, because you don't. It's pretty much that simple. Have a great week ahead. Thanks to all the traders who participated this evening. Thank you, Sam, for looking after us, and thank you all for being attendees in the Sunday weekly market update. Have a great week ahead. Bye-bye for now. See ya.